is Tesla is going to be at the forefront of being able to drive down costs and prices so that this idea of electric vehicles moving into the mass market is going to start to take root. So on Tesla, the end demand is the end demand. And in Shanghai, it does appear perhaps that high end demand is giving way to a little bit of low end from a pricing point of view demand because of the economy there. Yet in thinking about Tesla's positioning, now that supply chains have loosened up, I believe what's going to happen is Tesla is going to be at the forefront of being able to drive down costs and prices so that this idea of electric vehicles moving into the mass market is going to start to take root. Tesla is very aggressive at cutting costs and prices once we get out of this situation. So no, I'm not worried. In terms of manufacturing, which is the gating factor here, we need new plants as EVs scale, we believe, from 8.5 million units globally this year to perhaps 60 million in 2027. We think Tesla is going to be at the forefront of that. And so our conviction there has not diminished. Elon's main role at Tesla right now is moving it towards an autonomous taxi platform, which I think will happen in 2024. I think he thinks it'll happen next year. I think he is as focused as ever on that. And yes, he has had his hands full with Twitter. I think he's surrounding himself by the right engineers, and he's going to bring in new leadership. I notice, I don't know if this is going to be the case, but Brett Taylor, who just left Salesforce.com, was on the board of Twitter and certainly understands that company. He's an incredible operator. It'd be interesting to see him come in. I don't know if that's going to be the case at all, but I know he's going to surround himself by the right business leaders. He's not going to be running that company on a day-to-day
Cathie,
basis.
just to be clear, you think Brett Taylor would be a good choice as CEO of Twitter, is what you're saying?
When I saw him step down, now there are others stepping down as well, so maybe there's just an outright restructuring going on there. But I thought, he was on the Twitter board. Maybe, you never know. This is not even a rumor. I'm just saying he's the kind of person that I believe Elon Musk is attracted to and will surround himself at Twitter.
Sure. Hi, Julie and Brian. Well, if you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. So we've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world. And especially in the United States, it looks like some of the best supply chain managed companies in the world have over over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. This is a lagging indicator, and we're seeing a lot of prices in the pipeline that are falling.
So, Cathie.
Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.
Yeah.
Well, what's interesting, I think many people are coming around to the idea that we're in a recession or we're going into a recession. The first two quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction, but it's not going to be anything like we saw in 08, 09. That was a systemic financial problem caused by the mortgage and financial meltdown. We don't think this is the same thing. So now that many economists are starting to agree with us that we're in a recession or going into a recession, we feel that they might become a little bit too alarmist if this is just an inventory recession. And I think the Fed will have a lot to do with whether or not it is. This is a shock, though, to the system. And this idea that we have an inventory overhang, we think it's going to get bigger as consumers pull back. Low saving rates, 3.5% versus 8% where it was before COVID. And so we'll see. We think this holiday season is going to be pretty tough.